Good morning, it's Monday, October 15th, 2018. Straight from Forex. Let's go! So welcome to the Forex.Today YouTube channel. Thank you for hosting us, Forex.Today. We appreciate you. My name is Wayne McDonald. I am the Chief FX Market Strategist for TradersWay.com. I'm here to teach you how to trade Forex, technically, fundamentally, get your head screwed on straight psychologically, teach you how to focus your trading as a business with a long-term point of view, with risk management, all that kind of stuff. If I earn your loyalty and respect today, would you please visit TradersWay.com and open up a demo account and give us a test? We'd appreciate that opportunity to impress you. Also, if you subscribe over here on the YouTube channel, when I click the stream button, you will be alerted by YouTube and says, hey, Forex.Today just started a stream. Would you like to attend? And you're like, yeah, and it brings you right in. Super easy. Likes are appreciated. Comments are read. Please let me know what type of material you'd like me to cover. So like today, I suggest we cover the calendar. Set up the week, all that kind of stuff, right? Okay, right? So anyways, please all do that. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. All right, so I hope you had a wonderful weekend. I'm super psyched to kick some butt. Super psyched to get some things done. Super busy today. I bought a super fancy, souped up, customized golf cart. Like, if it can be upgraded, it was upgraded. And I get the whole, it was all delivered and everything, and the whole family gets around. My dad's visiting from out of town, and he comes out, and the wife comes out, and the kids come out. They're like, oh, Daddy, it's awesome, right? We get on the golf cart. We're driving down the street, and it starts going, like, okay, I don't think it's supposed to do that. So he turned around, and I called the guys. Anyways, he's like, you know what? I'll just bring you out a set of 4 new wheels, 4 new tires. I don't know what the problem is, but I'll take care of you. So huge letdown there. So anyways, that's one of the things going on. The guy's going to come all the way back. It's going to be an hour and a half each way for him, and he's going to swap the wheels out. So yeah, I'd like to actually drive my new golf cart. Rambo golf cart. It looks like a 50s hot rod. Let's just put it that way. It's pretty cool. So disappointing that it didn't work, but anyways. So lots going on today. Let's just jump into it, huh? Pachow. So what do you want to do? Well, I guess we'll just start here, kitty cat yen. We left this last week with support on the bottom, resistance at the top, right? Thank you, Captain Obvious, right? And what do? Well, if you're interested in buying, you look for an opportunity to buy at the bottom. We had this scoped out. Now, let me zoom in because we're already on a 15-minute chart. We had this scoped out like if you were going to buy it on Monday morning, Sunday afternoon type thing. This is sort of the area that you were looking. Right, there's the Friday front run. This is the sort of the Monday morning area. And, you know, it's not the world's greatest opportunity as a bull, but it's still bullish. You know, to put it this way, could an intelligent bear sell in this area? No. But being, take that one step further, should you be buying down here? No. So bears need to sell high, and maybe kind of did it here. You see kind of there's a role reversal in here. You see that? So bears absolutely did what they were supposed to do. So good job, bears. And bulls actually did what they were supposed to. And if you did anything different, nobody knows what you're doing. Okay, but you can see this Monday morning. Wait. Where is it? I can't see it now. Where's the Monday morning open? There's that there. Oh, now I got the drawing tool. Anyways, let's try this. Up in there. All right, so anyways, a reasonable sell open, right? This would have been the open right here. Would have been an okay sell open, right? This is your Sunday afternoon. If you're a bear, lower low, lower high, that's a great sell. And if you're a bull, you know what? That's kind of what you're looking for as well. This is quite okay. So if you're a bear and you sold up there, good job. If you're a bull and you bought down there, good job. If you did anything else, right? You need to tweak. Okay. This is our extension up into there. That's just from trading. Let me delete that. So we have this idea, if you happen to be a bull, remember we talked about how to anticipate a reversal. Remember we were still like, we planned out a fall, then we planned out a neckline kind of retracement, then we planned out a right shoulder. But I think we did this on Wednesday. And it wasn't that it was going to reverse. I believe our conversation was, if it was going to turn bullish, how would you plan it out, right? So I kind of have to move that now that we have the space. And what do you think so far? Again, it doesn't look like it's happening. It has a very good chance of happening, but there isn't. It's still not for sure, I guess is what I'm trying to say. You know, I got to move this back now. But as far as the planning process, right? Okay, you see what I mean? Down, if it was going to retrace, back to a neckline. Here we have the neckline. And then if it's going to inverse head and shoulders, it needs to make a left shoulder off the right shoulder. So we got this, and we drag that across. So, you know, up on Thursday, down on Friday, and maybe if you're a bull, up on Monday. You see what I mean? It's all right. Now, if this was going to fail and the bears were going to actually take this down, so it's more like down, consolidate a little bit, and then down again. Not the world's best pattern, but, you know, it can happen. How would you play that? Well, if that's the case, this area here is probably your best sell. Oops, boo. I hate when I do that. I should just get rid of that button. This one. Okay. But do you really want to do that after this much of a formation of an inverse head and shoulders? Langa says, "Hey, can you help? Can you explain how to use Bollinger Bands and PSAR to place my stop loss?" No, don't use either of those to place your stop loss. Okay, so I'm not sure what other guru you've been talking to, but you can use a PSAR to suggest after the fact where to put a stop loss, and that's fine. I mean, if I had to pick one, that would be it. In my opinion, someone using a Bollinger Band for a stop placement doesn't quite know what's going on. And they would argue against it and all that kind of stuff. And I can almost guess who taught you that. Okay, is it, you know, both of these PSAR and Bollinger Bands are volatility based and that kind of stuff. There's just, if I was going to teach you how to use a stop loss, I would master, or I'd have you master price action, not volatility. Now, a volatility person would say, well, you know, a PSAR, for example, will pull your stop in as volatility wanes. And, you know, it lets your winners run, and then it locks in profit. I'm like, oh, okay. Yeah, okay, that's fine. So depends on where you've entered this trade. So let's kind of mark this up technically. So let's say you were a bull and you were buying down at support. Great. So somewhere in here you bought. Great. And then that would move you, that would put your stop here. Unfortunately, to make it easier, let's change the colors. We'll make it like an ice blue or something. Where's Dodger blue? Is that cadet blue? Let's do cadet blue. Okay. So your stop would be there, and your entry would be, let's say, on this pullback. Okay. So up, 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 down, buy. Okay. So you're here. Your stop is here. And then each candle you move it. Okay. After your first trade, it's moved 1 pip, or after your first 15 minutes, right? Next candle, 2 pips. Next candle here, right? Next candle here. Next candle here. Next candle here. That's how you could use it if you want. But your price is way up here. Okay. Now you see when price starts moving sideways, no higher high, no higher high, no higher high, no higher high, no higher high. You know, this kind of stuff. Notice how instead of moving almost nothing, notice how you're moving it more and more per candle now. A lot, significantly more, significantly more, significantly more, significantly more, significantly more, but yet price isn't moving up. You see how that works? And that's okay. And what it's suggesting is if it's going to consolidate, you face the risk of it reversing, so you might as well jam your stop. Okay, that's fine. Cool. I wouldn't do it that way, but you could totally do it that way. What I would rather you do is master price action. Okay? Now, price action... let's say, as long as it's making higher lows and higher highs, okay, you can move your stop from, let's say once you make this new higher high, you move your stop here, okay, and now it's retracing. Do you move your stop? No. Okay, and I guess that's someone using a PSAR would argue instead of price action, you want the volatility. Okay, fine. It's one or the other. Each have their strengths and weaknesses. But once again, once it makes a new high, breaching this top, you would just simply move that. Okay, and you keep doing that. And now I've run out of room. So let's just change this. Let's just get rid of this. All right, so... right. Okay, so now you buy it now. Stop is at the lower low. Okay. You know what? Let's do it this way. Let me try to do it step by step. Okay, you buy it on that pullback. You put your stop here. Okay. It makes a higher high. Move your stop. Okay. Higher low. Wait for it. Higher high. Move your stop. Okay. Higher high. Move your stop. Gee whiz. Okay. Okay. Here's the issue. You see this, the size of the pullback? This is where you take profit. Another way of looking at it is move your stop, basically. Okay, 100% retracement or near it is a huge red flag. Okay, and the fact that it's struggling at resistance indicates that it's probably going to do this, and that's called a reversal. Okay, so a lot more intuition, let's say, or not intuition, more analysis. You have to see that it's made a pullback that's too big. You have to anticipate a lower high, all that kind of stuff. Because what it does is it creates the inverse head and shoulders, is what I just did. Here's your neckline, right? Here's your shoulder line, right? So in that case, if it's going to reverse, get out. Now, PSAR is just going to kind of draw its dots. So, but bear in mind, where would PSAR actually take you out if you're going to use it as that? It'd probably take you out here, because it's based on the touch. So either here or here. So it's either a little early or a little late. I mean, it's one or the other, as long as you get out, you know, when the market is consolidating, right? So let's go back to just a basic setup here. And then throw your PSAR on. Okay, and then you got to, I'd look at it on a higher time frame if I were me, but okay. Okay, you can use it like that. Now, what a lot of people make mistakes with PSAR is they think the dots dropping down mean buy. No, you should have been way down in here, as I already showed you. Right? If you were a bull, you should have been ready for it. This would have made the high. This would have made the pullback. And, oh, gee whiz. Okay, and you should be long about there. So let's say about there would be a realistic price. That's where you should have bought. Okay, PSAR is telling you like way up here or way up here. It's a bit late. Okay. Right, and all PSAR does is it rises until it touches the dot and then drops the dot down. So notice it doesn't even touch the dot until it's even high on the candle. Right, which is you're buying high now, and you're buying high reasonably close to support. And usually it won't even print the candle, the new dot until you're on this candle. So you can see by the time you buy it, you're 1, 2, 3, 4 hours late. Certainly 3 hours late. Now, I would never recommend a system that puts you in 3 hours late, right? But nonetheless, if you were long now, PSAR is telling you your stop should be here. And if you bought here, look where we are now. So we're here. Okay, that's where we are now. You were supposed to buy in this gray box on a smaller time frame, like a 15-minute or a 5, and your stop is here. Okay. Okay. So I'm not saying one is better than the other. I'm saying one I prefer more than the other. Both strategies have strengths and weaknesses, right? Did you ever play video games, right? The big guy is super powerful, but he's slow, right? The fast guy is super fast, but he's weak. He has to hit you 20 times. You know, that kind of stuff. There's always a balance to your strength, right? So in this case, I mean, this is obviously easier to watch if you just can't make your decision, or you don't have the skill level yet to make your decision of, oh, that's a significant pullback, I should lock in my stop. Okay, then use PSAR. The whole volley band for that, nah. I'm sure it could be done like this, but I wouldn't do it that way. What are they doing, using the lower Bollinger Band? Nah. Couldn't imagine what they're doing with the Bollinger Band. But whatever. It's sellable though. When you talk to an amateur and you're like, oh, well, you should use your Bollinger Bands to place your stops. Really? Yeah, it uses volatility. Oh, that makes sense. Right? I wouldn't do it that way. It's a great sales pitch, though. You know, I would say almost 90% of the answers in currency trading will come down to price action. So go back to what my basic advice to you has been. And you either take a course at FX Bootcamp, shameless plug, right? Or what? Or you go somewhere else. But you need to educate yourself on two things: price action and pivot points. Okay, price action will take care of where your stop should be, and your pivot points almost always will take care of where your limit should be, right? Because both are not lagging indicators, but leading indicators. You see that? They're leading indicators. Where should your stop be? Oh, well, look at price action. Right? Because, anyways, and then where's the target? Oh, that's going to be a pivot. Done. Okay. Now, Joe says, PSAR helped me maintain my nerve and the trend. Okay, that's fine. I often call it training wheels. Oops, I didn't know my color was messed up. I often call PSAR training wheels. It'll be fine, but eventually the wheels have to come off, right? Like, again, Joe, like Matt, imagine you were running a $1 billion hedge fund and a big client comes to you and says, hey, when are you getting out of that trade? You're like, I have no idea. I'm just waiting for us to lose enough money for PSAR to knock us out, right? Now imagine a lot of this, like, where were we on PSAR? Imagine this, like, what if you just sat on PSAR to tell you when to take you out? But what if the pivot, aka support and resistance of the market, actually tells you when to get out? Not on the pullback, but on the up touch, right? Like, isn't the better money made? Like, for example, let's say PSAR took you out here, okay, on that pullback. But what if this was the better out? And that has nothing to do with PSAR. You're like, well, what is this? Well, maybe it was a psychological level. Maybe it was previous resistance. Maybe it was a daily pivot point, a weekly pivot point, a monthly pivot point, a cluster of pivot points, right? There's all kinds of reasons. I'm not saying this is a good one. I'm just saying, what if that was the top for some sort of logical reason? Then you're like, well, I don't really manage my trades. I just let PSAR do it. Now, I know that's not what you're saying, but I'm exaggerating for effect to enhance the learning, right? You don't want to get in the habit of like, I only trade mechanically. I only do what my chart tells me. I do trust technical analysis. I do trust my indicators. I always say they're 100% right because they're only algorithms. Well, what does the algorithm do? Some sort of math, and based on the math, they put some squiggly lines on your chart. So PSAR will not put your kids through college. PSAR will not take care of your family and your friends and your community. PSAR just measures volatility. This is the moneymaker up here, guys. Because if it was PSAR, if PSAR worked beautifully, shoot, I just put PSAR on my chart and just let it run 24 hours a day printing money. But you know that don't work none, as they say in Georgia. Right? So anyways, so PSAR can be a good place for you to practice moving your stop based on volatility, but don't become like a PSAR lover. There's other things going on in the world besides PSAR that you should master, and it's a good place to start, like I said. Oops. Price action pivot points, guys. Do that for 5 years and then add the other stuff on. Right? And then some guy will want to sell you a weekend seminar about how to use Bollinger Bands, and you'll look and you're like, oh, well, seems like an empty weekend. All right. All right, so we left it at this. As you know, right, the big move in exotics, which we predicted, the retracement, which we predicted, and then the potential extension, which we also predicted. Very nice. You say, well, what is this up and this up? Well, this goes back to last week where I said, if you're a bull, where would you buy? Plan A would be there. Plan B would be there. Doesn't mean I want it to go up. I'm just teaching you how to put together your trade plans. Okay. The lower low, lower high, I think supersedes all that unless something really changes fundamentally. But look at that. That's pretty simple stuff, right? Down, 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 up, up, right? So in this case, what I'm hoping to see is that plan B touch, all right? And you notice, like I was saying, so let's say this is where bears are going to go first. Now, bears would like it to go lower, but what this tells me is they would like it to go lower, but it's not likely to go lower this week. So what happens if we hit the low on Tuesday or Wednesday and we're here? It's not likely to go lower based on technical analysis this week. Now, it could go lower, just not this week. And then you find yourself having a retracement, but something that makes us vulnerable on a double bottom. See, that's the part I don't like. Like, I wish this green zone was down here, but it's telling us we don't have the volatility to get there. Oh, there's that volatility word again. PSAR, volley bands, and maybe even pivots, because pivots will adjust based on what's happened in the past. But that's what volatility is. Was the last candle this big? And now it's this big? Then we lose volatility. Was yesterday's trading range, this big, but now it's this big? Last week, last month, right? That's all. So in a way, I mean, it's not the only thing it's measuring, but you could interpret it that way and just say, well, when we're moving ripper fast, yeah, we would have the let's say the relative strength to bust through there, or we had the velocity to bust through support. But what if we lack that? So you could even argue, see how these pivots are inside these pivots? So you can say, well, we're not going to bust through support on an inside week. We don't have the volatility. We don't have the velocity. We don't have whatever word you like. Okay? So down, 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 consolidate, consolidate. That's what I see in like 1 second. Okay? Now, if I were to add some time to this, it could head here and then all the way back up to 115, and everyone in South Africa would cry. Because that's not good. Okay? Now, someone else, a true bear, sold it up here. Do you remember that plan? That's what this was. Do you remember the giant inverse head and shoulders? So now that we've actually made the bottom and made the top and now are looking at the drop, let's replan this. You go from the top of the crown to the neckline and take this to the neckline now. And if it does form a daily inverse head and shoulders, our South African brothers and sisters are going to love being back down to like 112 and a half, or sorry, 12 and a half. 12 and a half is a whole lot better than 14 and a half. Okay. Neat, right? You might as well mark that. Right, and the next one obviously is going to be there. Now, what is going to do that? Is that going to be a huge improvement in South Africa? I would have to bet against South Africa on that one. I don't think there will be radical, amazing improvement in South Africa. So that means dollar weakness. Okay. Well, John, here's a thing like some people will tell me that they cannot trade like, here's one. This is typical. Because, I preach one particular opportunity. That's not set right. I teach one particular opportunity. I've done a couple of videos on how to trade the Mexican peso, right? And the typical response, where's my peso? The typical response to the training, that must be it, yeah. The typical response to the training is like, hey, nice setup, Wayne, but there's no way I could trade the peso with that spread. And they look at it and they're like, 80s, I don't know. It's so funny. I can't think that way. Anyways, people will say the spread is ridiculous. How many ever pips that is? It doesn't look like a lot to me. Okay. That looks tight to me. But anyways, that's the common response, right? I'd love to trade that Mexican peso trade that you explained to me, Wayne. It looks really good. I understand it. But I just couldn't possibly trade it because of the spread. But here's the thing. Take one mini lot of the euro dollar and take one mini lot of the USD Mexican peso. Okay? And do a trade. Just trade one mini lot versus one mini lot. Okay? And then one of them will be like 100 pip spread, a 200 pip spread. You're like, oh, I could never trade a 200 pip spread, right? And then do the next one, right? Or I guess it's 20 pips. I guess what we're looking at is 83 versus 84. I guess now it's 10 pips. I mean, dude, it's so tight. Anyways, so you're like, I could never trade peso because of the spread. And then so take the mini USD, Euro USD, take the mini USD peso. Regardless of the spread, look how much money is involved. And you're like, oh, well, the difference is negligible. And why is that? Well, a peso isn't a euro. You understand? So a peso, when it comes down to the spread, you're like, oh my God, the spread is this huge number, whatever, 10 pips, 20 pips, 30 pips, 40 pips, 50 pips. And then you look at it, you're like, oh, well, that's not much more than a euro dollar. And it's because you're comparing apples to apples, but the peso is not a euro. The peso is not a dollar. The peso is not a Swiss franc. A peso is a peso, and it's worth significantly less. Therefore, the spread looks high, but the cost is the same. So you might walk away from a 100 pip trade because you don't want to pay the 4 pips in spread if it was a euro dollar. But I'm pretty sure if it was a euro dollar, you would take it without even looking. And that's my point, right? You might take the pound dollar without even looking at the spread. You just trade that all day, every day, and you would never, ever, ever consider a peso trade. And you might get yourself in that mindset based on the spread difference, like, oh, one's got a huge spread and one's got a little. But at the end of the day, it's the same amount of money. But you would only look at one and you would never look at the other. And you have your mindset because of this certain reason, but it's not reality. That's all I'm pointing out. So before you lock yourself into, I always trade that and I never trade that, do the analysis and just make sure your what do you say? Not opinion. What am I saying? I got wives' tale in my head. Your certainty or your just make sure your facts are straight. That's all. Because you might find when you do it, it might open up possibilities that you just never considered before. And that's called maturity, right? And suddenly you're like, oh, well, I'll trade the peso under the right circumstances. And that's kind of where I want to get you, right? So that's that. Just, that's where we're getting, right? So that your analysis is a whole different level, right? That's all. That's where I'm trying to get you. Don't lock yourself into assumptions. Maybe that's it. But there's a word I'm searching for. I don't know how you say it in English. It's not assumption. It's stronger than assumption. It's not opinion. It's sort of factual. I don't know. All right. Conviction? No, that means like you got something behind it. I'm thinking of like, you know, it's just factual to you. You just know it's true. Kind of like a wives' tale, but I can't think of the preconception or yeah, that's closer. Bias? No. Again, that's your interpretation. Just imagine like I'm looking for a word like it's, you just know. You just know. It's to you, it's a fact. You've never actually investigated it, right? And you've never done any research, and no one has actually really taught you, but you know it's true. And then, and very often in these situations where you just know it's true, then you go look into it and you find out you're wrong. You know, like, I don't know, if you were applying it to people, you know, you get like racism, right? Oh, so-and-so people are not as smart, right? And you're like, dude, that's racist, right? But, you know, a racist person would just have that opinion, right? Just built in their brain. Well, where did that come from, right? So, like, well, what if you had that applied to something else in your life? It's just a preconceived, built-in knowledge which you believe is factual, and then actually you look into it and you're totally wrong. You're like, wow, where did I get that from, right? So that's kind of an instinct isn't right too. I don't know, like maybe, I don't know. I guess I've been reading too much French poetry lately, because you know French poetry will have 1,000 different words for one thing. So anyways. All right, so it's going to be a busy week, yo. Okay, yeah. Retail sales, boom, boom, boom. Did you catch? Are you watching the banking numbers come through? Banks are doing fantastic. Consumers are super happy, guys. Okay. U.S. consumers are super happy. Everyone is filthy, stinking rich in America, even the poor people. Okay. So everything's booming here. Retail sales they're going to come out hot, most likely. So that's pretty cool. Bank of Canada Business Outlook Survey. This is something that nobody in their right mind will read. So why don't you read it? Because there's going to be good information about the Canadian economy. 95% of traders wouldn't read it. But what if you work for a hedge fund? Super successful hedge fund. You're making $1 million a year as an analyst / trader / portfolio manager, right? And your job is to be an expert in the Canadian dollar. Would you read that in that situation? Brooke, what's going on with the Canadian dollar? I'm waiting for PSAR. Right? We haven't hit PSAR yet. I have no idea what's going on, but I'm waiting for PSAR, and then I'm going to change everything. If it don't work on a 4 hour, I'll change to a 1 hour. Yeah. So anyways. Yeah, so of course you would, right? So take an opportunity. Just say, well, only the top 5% of traders in the world are going to read that. And then ask yourself, do you want to be one of the top 5? You know, so yeah, go for it, bro. You might have to waste a whole whopping 15 minutes. Right? Is that? Okay, John. Anyways, so yeah, go for it. Read it. Great. What else? Kiwi inflation? RBA meeting minutes? Chinese inflation data? Maybe I should trade Asia today, huh? Let me repeat. New Zealand inflation, Australian meeting minutes, right? Central banking meeting minutes, Chinese inflation data. What should you do? Skip it? Yeah, skip it. Nobody cares about China and Australia, New Zealand. Like, oh my God. So yeah, you should be on that. At the very least, should you read the RBA meeting minutes? It's up to you, bro. Yeah, imagine you're a currency trader and you don't understand central banking. How long will you last? Because it's funny, if you worked at a bank, let's say, that's what they care about. That's it. That kind of stuff. It's all about interest rates. Okay? You get hired by some bank and they'll put you in the FIC department. Fixed income, so your boss is going to be a bond trader. Fixed income, commodities, and currencies. Okay, so you walk into work, you sit in the currency trader corner, and who's your boss? Commodities trader? Niet. Currency trader? Niet. Fixed income, bonds, interest rates. He'll say he's an interest, or she will say she's an interest rate trader. She may not even say, because it could be bonds, it could be treasuries, you know, it could be all derivatives of that, but it all comes down to interest rate. Interest rates. And who sets interest rates? Central banks. So your boss is going to like badger you all the time about what's going on. You're like, well, Madam Butterfly, I just read the RBA meeting minutes and they said blah, 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 blah. So just back off. Okay? Then she'll go away. It's your job, guys. Love it or leave it. If you're finding ways to get around doing the work, you ain't going to work. Right? Don't try to find the short way to success, guys. Love being a currency trader. This is the work, and you should love doing it. Okay? Love doing it. Love downloading the RBA meeting minutes. Okay? Love it. Okay. Tomorrow, German zoo? I suppose. Okay. Oh, I forgot the pound stuff. Yeah, well, you know, again, this is like a leading indicator toward inflation. But, you know, it's one of these things like with Brexit and stuff, like all these normal things seem almost pointless, right? So anyways, there's a lot going on in the minds of the British. PCE, which is a subcomponent of GDP. Now this is important to the United States of America because the Fed uses PCE as a measure of inflation, not CPI. Okay? Slightly different math, but let me explain it this way. Both use a basket of products and services used by Americans to get through their daily lives. Okay? It could be lawyer fees, insurance prices, rents, the price of corn, all this kind of stuff, right? Everything. And it's thousands of products. So quite literally, if legal fees are going up, it gets recorded in CPI. And it gets recorded in PCE. The thing is, the methodology in computing a basket is different. And the numbers will come out different. Okay? And the CPI, the PCE basket uses different math and updates more frequently and should give you let's say, a more short-term accurate number as far as actual prices going up and down. So like, for example, what you might find that doesn't work on CPI because it's slower is like, let's say chicken prices are going up and up because there's a huge crisis and we lose 50% of all chickens in the United States. And let's say chickens are in the CPI basket, okay? And of course in the PCE basket. And chicken goes up 300 or 400%. What do you do to adjust as a regular folk in America when chicken prices, would it cost you $15 a pound for chicken? Do you pay $15 a pound for chicken? Do you eat less chicken? Do you eat more chicken, or do you change your behavior somehow? How do you change your behavior? Substitution. John says substitution. You stop eating chicken and you buy something else. Now, I would have said, instead of beef, I probably would have said pork. But then, you know, maybe there's a religion thing or something. But whatever. You find a substitute. It's not that you eat less meat. You just don't eat, you eat less chicken and you eat something else, right? Apples for oranges. If apples go up 1,000%, you just eat some more oranges or pears or something else, right? So it might take CPI, it might take a very long time for that update, and CPI can go through the roof, and it's just being, let's say, is dramatically affected by this increase in chicken, where PCE would adjust more quickly and allow for the substitution, where CPI would not allow for the substitution, all this kind of. So you could study this for days, the difference between CPI and PCE. And I've done the math, and it's wonky, you know, a bit of calculus, but, you know, there is a difference. The most important thing you really need to know as someone beginning in the business is the Fed uses PCE, and the Fed adjusts monetary policy. Monetary policy impacts interest rates, and interest rates move currencies. So you should say, oh, I should watch PCE. And then when you sit down with your rich clients and they start talking about inflation, because rich people are worried about losing their money and inflation eats your money. So you say, oh, well, did you know the Fed doesn't actually use CPI as an indicator of inflation? And they're like, really? Yeah. Well, they use a different thing. And then you just go through this whole speech. And they're like, oh, my God, you got it, man. All right, who's pinging me? Oh. That's good. Oh, man, I got to talk to that dude. Anyways. So anyways, there you go. That's coming out. You should pay attention. Hey, maybe you should read it. Euro Brexit Summit. Sounds like a lot of red wine and cigarettes, huh? All right. CPI out of Great Britain, right? Once again, I'm like, well, that's typically okay. Yeah, okay, you should be there especially if you trade pound. But I wonder if it's overshadowed by Brexit. Then you go to retail price index, and it's one of these things like, if the numbers are bad, what are you going to do? Right? Oh, yeah, thank you. Yeah, so if the number's bad, what are you going to do? People are going to say, oh, well, that's Brexit. See what I mean? So, you know, I don't know if it'll change anything, but it's something that you should pay attention to and be involved in. And gee whiz, my phone's freaking out. Dude, I need to talk to this guy anyways. So anyways, yeah. In Europe is Europe, right? You know, it's so bad in Europe now. It's too bad because a year ago things would look like they're improving. Europeans do not buy products from foreigners because they don't have any money. Isn't it amazing? And there's still 10 years after the financial crisis, there's no productivity. When will Europe decide or realize socialism sucks and is guaranteed poverty? When are they going to get it? So there's no productivity in Europe right now. They don't have any money, so they're not importing goods. Well, why would you import a good? Well, those workers are going to make things for you for less than it costs your workers. So you're off. You have a relative advantage, maybe even an absolute advantage. So why would you do it yourself when someone else will do it for you? Why would you clean your own toilets when you can get a maid, right? Especially if the maid is $4 an hour and you make $400 an hour. Well, get a maid. Why waste your time, right? Well, the thing is, what if you don't have any money? Then a $4 maid is super expensive. You're like, why would you pay $4 an hour when you can do it yourself, right? So that's where Europe is right now, cleaning their own toilets instead of hiring an immigrant, right? Come on. So you look at the data, they're not importing anything. And that's a bad sign. So I want to run for president of Europe. I'm going to save Europe. I want to be chancellor. Boy, that would sound good, huh? You got a cocktail party, you're just standing there with your drink. Someone's like, hey, what do you do? Oh, well, I'm chancellor of Europe. It's a pretty good gig. Got to travel a bit. It's all right. Chancellor sounds good, huh? Right? You know how people have stripper names? I'd have my European name. My name would be Helmet. FOMC meeting minutes. Whoop, 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 whoop. Yeah, shields up, red alert. What is the Fed thinking? That is the biggest question there is in currencies, because they manage this, basically the strength or weakness based on the supply and demand, and mostly, well, supply. By managing the supply of dollars, they influence its strength or weakness, and it's the reserve currency of the world. Lord Helmets. Dark Lord Helmet. Yeah. Or just call me Motorcycle for short. Anyways, yeah. So read it. What we're interested in how many more rate hikes, and is there even a thought at the Fed about increasing or decreasing the velocity of these rate hikes? Right? Are they going to slow them down or speed them up or keep it the same? And if so, like for how long and all that kind of stuff. Right? So anyways, do you remember maybe a year ago, you heard a lot about the yield curve probably inverting and that the economy is going to crash? Do you remember that about a year ago? What did Uncle Wayne say about that? I said, poppycock! No way that's going to happen. And even if it did, it doesn't mean the same thing. An inverted yield curve in a market like we had, especially a year ago, is not an inverted yield curve in an overly heated market. And whoever would say such a silly thing, and these are people on TV, so they're experts, right? And they have lots of money under management, which means like some dummy is managing a lot of money made by dummies, right? But they're looking and they're like, in the textbook it says inverted yield curve means this thing, but what they don't understand is, well, it's not the inverted yield curve, it's the actual economic cycle, and it's the actual economic activity, and it's so they're scratching the surface on knowledge, and they're calling it fact, right? So anyways, a year has gone by. We still have a very flat yield curve, but it ain't going to invert. It's not going to invert. So we're probably 4 years away from the next downturn, which is really good. That'll be really good. And the Fed, imagine for the next at least 2 years, right, keeps raising interest rates. So interest rates will go up, which means the bond market will keep falling, which means bond rates will go up. And about 4 years from now, I'm going to cash out of the stock market, and I'm going to put all my money into high-yielding bonds. Not high yield, meaning like risky bonds, but, you know, a good AAA bond that's paying 4 or 5%. I'm just going to plow it all into that. Maybe a nice corporate bond, a good safe company that's paying 6 or 7%, you know, put all there. And then we're going to have a crash, and I'll say, aha. So we'll go through another 8-year, let's say 2-year down or 1 year down and 3 years sideways kind of thing, and I'll be locked in. With bonds that are paying a high yield. But what happens to a bond? And suddenly everyone wants to buy the bond because the stock market is dropping 30% and the bond is guaranteeing you 7%. Do you want to lose minus 30 or make plus 7? Thank you, Johnny. Well, of course, everyone wants the plus 7, right? Especially if the Fed's slashing interest rates to help the recession. So suddenly everyone wants out of the stock market because it's crashing. They want to buy the bond market. Everyone wants to buy that bond because it's good and it's paying a high relative yield. So what happens to the price? Everyone's trying to buy it because it's the best deal in town. Price goes up. So now I'm earning 7% when the Fed is slashing interest rates. But because the stock market's falling, everyone wants to buy my bond, so the price of the bond is going up. I'm getting paid 7% and making money over there, which is a lot like doing a currency trade where you're long and getting paid interest. So then you're like, well, why would I be in a bond? Why would I want a 7% Ford bond when I can make a 70% carry trade in the foreign exchange market? And you're like, 70%? Yeah, well, I'm leveraged. So all of a sudden you're like, yeah, maybe I should just be in the currency market. Pa-ching. The problem is the yen would be strong, the dollar would be strong, and there wouldn't be a carry. So the reverse carry is buy yourself a nice, safe corporate bond. Enjoy the appreciation. And earn the income. Because remember, if you have 7%, your money will double every 10 years. So a 5-year period, let's say, dumb it down, you'll make 50% net worth increase. And if this was a big decline, if there is a dramatic decline in the stock market, your neighbors will have lost 20 or 30% in that period, and yet you made 50%. They lost 20 and you made 50, so they move out of their house and you buy it cheap, and you rent it back to them. It's not your fault, you're wicked smart. All right, seconds away from the number. Today's webinar has been brought to you today by Trader's Way. It's your way at Trader's Way with Trader Wayne. Please visit tradersway.com today. All right, here we go. Beep, 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 beep. Is it good? They put so much data in here, never can. Flat. Underlining okay, though. There's a little bit of okayness to it. It's not good, but it's not bad. What else is going on there? So people are still buying cars, but it's not out of control. So I don't know. This stuff doesn't say much, but anyways. It's going to be a little bit disappointing though, right? Because everyone wants the hot numbers. Elvin, things like goodbye, GBP, don't think that way. Put it this way, it's probably not going to be anywhere near as bad as what you're hearing on TV. And most likely, it's not the end of the world at all. I wouldn't even be shocked. Like, I don't think it's good. I think it's bad for, like, free trade is the way to go, in my opinion. Right? I can see what Trump's doing. Things need to be renegotiated with all our trading partners because we were the only game in town 30 years ago and 40 years ago when a lot of these relationships were made. Well, the rest of the world is caught up. It's called the catch-up effect. So they're catching up, and there's less need to basically subsidize the rest of the world for economic development and, of course, for the sake of promoting capitalism. So it's time to renegotiate. That makes sense. But like the British pulling away from the European Union, yeah, that doesn't make a whole lot of sense to me. Now, people, I don't follow it. Obviously, I don't live there. I imagine if I lived there, it's the only thing you hear. The one thing I hear about is it has to do with immigration and all that kind of stuff. Well, when has London not been full of immigrants? And if you have a problem with immigration, change the immigration laws, and maybe they can't because of a euro or whatever. So they've got to do what they got to do. It sounds like a mistake to me, is what I'm trying to say. But I don't live in the UK. I don't follow the politics and all that kind of stuff. If Europe is going socialist pig dog, then if I was the leader of England, I wouldn't have called a referendum. If I was the leader, I would just pull out, man. I'd be manly about it. Yeah. So in that case, like, yeah, should the UK turn into France, Germany, or Italy, or Spain? No, come on. So yeah. So if you got to pull out, pull out. But free trade, you want to keep that. So pull out, renegotiate some free trade deals and all that kind of stuff and move on. So maybe if Europe is going this way, if it's, I guess another way of looking at it, if Europe is the Titanic and and you can see the iceberg and the French captain is smoking, right? No, we'll do it the other way. The French captain is drinking a red wine, and the German captain is smoking a cigarette, and they're like, what iceberg, right? And then you're like, all right, right? Now I have to do it in British accent. I will get the, I don't know. So you get the lifeboat, and you're like, I'm in the first one on the lifeboat, man. I'm getting off. It's dangerous to be in this little dinghy in the middle of the Atlantic at night. Freezing cold, but it's better than being on the Titanic. I don't know. Make up your own analogy. I'm having a bad analogy day. So, yeah. Whatever he just said. Jim says it's about escaping socialism. But you know what? The UK seems like a bunch of socialist big dogs again, right? So, I don't know. And I'm a capitalist. I believe capitalism fixes everything. You want to live longer? Be a capitalist. You want to live happier? Be a capitalist. You want better education? Be a capitalist. Yeah, right. Yeah, be careful, man. Be careful. Don't pull my leg too much. So, wow. Woo. Look at this craziness, guys. Woo. Awesome. Now, if you have a trade plan, this just sets up your trade plan, right? So did you sell at 116, for example? That would have been a pretty basic trade plan. I don't think I want to play that way today. So as long as it keeps going up, I'm okay with that. I don't want to buy it near resistance. If I was going to buy it, I would have bought it here, right? Like a basic swing trade plan, right? Joe, there's no reason for Great Britain? Come on! Where would you rather go for your big financing deal? You want to go to London, Paris, or Frankfurt? I say London. So let's go here. WTI, let me move this so now that we have some time. All right, double bottom, higher high, wait for it. Now what? Well, there's two ways of doing this. You can fib or you can use that. Your call. Or you can do it this way. And you can see it's a perfect 618. Well, not perfect. Mostly. Well, I guess you can do it this way, and it is perfect. Okay. And what does it all mean, Basil? It means if you're a bull and you're trading the double bottom and you get the higher high, you need to have the higher low, and then you set that up. Okay. Very, very straightforward trade. Right? You can look left here. The other area is this. Okay, so you can see it's quite a coincidence, but it's almost always the case. Almost always. So there's going to be a level of confirmation bias in here, but I'm okay with that. Let's move this up here. Okay, so it's either a 3A2 buy or a 618 buy. But then you look at the monthly central pivot and you're like, oh. Yeah, Mark says we've always been outside the EU. I would say that too, right? And there's something about the British too that is different from the Americans, which is great. And I think I've told the story before, but I went to a cigar bar in London, and right next door is the shoe store for the royal family. The royal family's been buying their shoes there. Anyway, so I go to the cigar bar, and it's pretty early. Like, I'm there like 11 in the morning or something. So I'm pretty much the only person in the shop. And I go upstairs, and sure enough, only guy in the room. And I get a nice seat by the window, and I get a nice cocktail, and I got my fabulous cigar. And then after about 10 minutes or something, some gentleman walks in, a true British gentleman. And he walks in, beautifully dressed, but casual, right? Beautifully dressed, but for him, it's casual. And he comes in, and he's got a shoe bag, and he just bought shoes next door, right? He got his $4,000 shoes. Anyway, so he's sitting waiting for a friend. And I strike up a conversation, and we're talking about Brexit and all that kind of stuff, and we're smoking our cigars. And, he's, right? Anyway, so I talked about, I think, buying real estate in Venezuela or something. He was like, yeah. And then we talked about money. And I'll never forget it. Like, the look in his eyes was like, oh, he doesn't deal with money. like making money. And he wasn't being rude, and he wasn't being arrogant and all this kind of stuff. It was the look in his eye, like, he doesn't concern himself with money. What a trivial thing to worry about, right? Like, his family made money 300-400 years ago. The way I kind of process this guy probably owns half of London, and his great-great-grandfather bought it, right? All this stuff, and then his great-grandfather, and then his grandfather. And now he just probably went to a great prep school and boarding school, and then went to Oxford or something, and and was just born into a job, and now he manages this stuff, or he manages his employees that manages his stuff, and he doesn't like money. Like, who worries about money? To even discuss it was like, you know, like, who talks about money? So he was bored. Then he's like, and then his buddy comes up and he's just like, didn't introduce me to his friend or anything. Just like, there's obviously I'm a poor scumbag from America and would have nothing of interest to talk about. Because, you know, I still like make money, or, you know, it's just funny. And you don't get that in America, because you could be a billionaire and you, in his eyes, are poor. New money, nouveau rich, right? So anyways, pretty interesting. So I want that to survive in London. Okay. So what do you think? You going to treat it this way? This is what we set up last week. So we have all these lines, but, you know, they're saying up and up and up and probably up. And then once they're up, maybe come down, right? So it just comes to, like, if this is your long term, then this is your medium term technical analysis. And, of course, if it falls lower than this, you're out. Okay? Remember, when we analyze it, it just tells you good places to buy or sell. It doesn't mean if it will go up or down. So even though it's a double bottom with a higher high, it doesn't mean it has to go up. You would just expect it to go up, right? So then you're like, okay, so this is clearly a buy area. I mean, that's not a complicated entry. So if you buy it here, then it comes down to where do you put your stop? And of course, you can put your stop here, and then, you know, whatever. And if it makes a higher high, you can move it. Or another way of looking at it, if we drop below here, just take the loss, right? Like, let's do it this way. So you bought it down here, 618 Fibonacci retracement after a double bottom at a monthly pivot point acting as support. Doesn't sound crazy to me. What if it does this? Well, then you change your mind. Or you ignore the monthly pivot and you play the M2. So you can still do that. So, you know what? I might even change my mind and say, well, I want to play the central. I want to play the M2. And that means I basically got to have my stop about here, below the lowest low. And then you can see, going even further back, I have another trade plan. So now I got to incorporate this. Wait. So let's back up. We have this double bottom. So we have a macro central M2. All right. So now this, our weekly doesn't overlap our monthly. How are we going to interpret that? We're going to interpret that we still think it's going to go up, but it's not going to go up this week. It's going to be sort of down to sideways. You see how I'm taking all this? Because for it to truly go up, we need to take these guys that want to buy it here, which is something we talked about last week. So we wouldn't mind if it dipped down here. We don't want it to. Complicates things. But if we can pick up these bulls and pick up these bulls, then it's going to be more bullish and more likely to go up. So let's try to incorporate that. I don't want to have it all, I don't want to move my stop all the way down here. So we got to have a plan A and plan B. So let's do it this way. I want to, like, this is a good buy around the central. And I'm going to try to incorporate that into there. So my first stop will be placed just below the weekly M2. The second opportunity is I want to buy a dip into here like I marked up last week. I think it was early last week. And so my plan B now is to buy it here. And that means it'll go up probably into this zone here. Okay, next week now we're talking about. And I can't even put it on the chart because it's too far out. So up into resistance, down into next week's swing long weekly central M2 buy zone, which I'm talking 7 days from now. So obviously I don't have it on my chart. But in there, it'll probably, if I'm right on my price action this week, be probably not that far from this monthly central. So I'm going to play the big double bottom, then the higher high, then a slight consolidation, and then by the end of next week, which is now what, today's the 15th, 10 days from now, 25th, around the 25th of October, we break out and rally to the upside. Cool. Well, anyways, that's a plan. Maybe that'll work out. Once again, am I thinking about what happened 15 minutes ago or what's going to happen in the next? No, I'm planning. I'm trying to incorporate things. If it rallies here, how will it work? How will it happen? And if it doesn't rally here, but I'm a bull, how would it rally? So that would be plan A. But what if plan B, so we go up a little bit further, right? And you can see I already have it marked up. Okay? Here. It's going to be here. Right here. Right? So, and if that doesn't work, I'm out. Okay? Is that too much info? Should I just delete the whole thing? Let's just delete the whole thing. I'm going to delete the whole thing, even though it's weeks and weeks and weeks of analysis. Whatever. Right? You got to be Buddhist about it. All right. If you wanted it to go up, you'd buy it somewhere in here. Okay? On a monthly basis. Now you say, well, Wayne, we already had a target and a drop. That's right. So if it were to pick up again, it has to do it around the middle of the month, not the end of the month. Oh, wait, today's the 15th. I'll call that the middle of the month. So that fits in my rules of engagement. It's okay. Now you can see the bears, right? Where would a bear sell? Oh, that's so easy. Come on. That's where they're going to sell. Okay, aggressive ones are going to sell here, but they're selling into support, and it ain't going to happen. They're going to pay the penalty. All right, so now if you're a bull on a weekly basis, right, what's the buy zone? Here. So why don't we just overlap the cluster, double bottom, right? Let's do it again. Double bottom. So we'll just call this a double bottom. It doesn't need to go lower. But remember, I was talking about this leading to the new low. Okay? So we all know this from last week and the week before, I believe. All right? But now the double bottom, right where we want it, up into here. Now, careful. Bears are selling right exactly where bears are supposed to sell. So bears, if you did what you're supposed to do, good job. Selling at the central, selling at the 4-hour 21, completely legit. What I'm hoping is you're going to be wrong, but if you are a bear, you still have to do that. Okay? And what I'm planning here is that. Now, I would like it to go further, but we don't have any evidence to support that. For it to go further, we probably have to come in here, roll reversal that, and then next week head up. But that's what I just talked about. Okay? And if you're a bear, right, you want to clear it out again? Clear it again. If you're a bear on oil, how do you do it? Okay, plan A is this area. Plan B is this area. Okay, I just planned out my entire week. Right? Don't fight me on this. Start planning. It's either going to do that or it's going to do that. And so what would you do? Well, one or maybe both. Now imagine you're sitting around trying to figure things out. What is it going to do this week? What's going to make it move this way? Or who's going to blah, 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 blah. Isn't it easier just to have a bias? Okay? Well, Okay, now John says I have permission not to take trades that smell funny. Well, you have to, you know, you don't want to stop trading out of an emotion. You have to have a factual reason. Okay. Now, I know you're trading your own money. Now, if you're trading for other people's money, then it's your job to trade. That's your job. Oh, man. Yeah, you know, look at the time. I got to go, guys. I went too long. Apologize. I got to take this call. See you tomorrow, guys. Sorry.